This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. A cautious open ahead for Asian stocks after Wall Street's rally takes a breather. Oil gaining on a report Israel may be preparing to strike Iranian nuclear sites. Elon Musk tells Bloomberg he's committed to still leading Tesla 5 years from now while paring back his political spending. It serves to ease some investor concerns. Plus, we speak live with London Metals Exchange CEO about new licensed warehousing in Hong Kong and curbing the big bets that have rocked markets. Well, let's get to those markets. Let's take a look at how futures are shaping up this Wednesday in the Asia Pacific. A little modest risk on tone for Japanese futures. We did see, as mentioned, US markets backing away from that bull market territory. We saw some modest declines for all the major indexes there. If we take a look at the yen, meanwhile, it's still pretty soft, 144.41 at the moment as well. We are expecting a reasonably bright open here in Australia when we get it. We've got ASX futures also in modestly positive territory, about 0.6% there. Not a lot of change there for the yuan. One exchange rate we are watching also, the Aussie versus the Japanese yen. The Aussie softening a little on risk sentiment. We'll get to that in a moment. In fact, let's take a look at that now. The oil price, one of the things that's moving impressively in the early going at the moment. We've got WTI 63.41 a barrel at the moment. That's up by about 1.3%. This is on the news being reported that Israel may be preparing to strike Iranian nuclear facilities. We don't have a lot of confirmation of that at the moment, but the market certainly moving first, asking questions later. S&P futures, meanwhile, opening a little bit softer as those markets continue to reverse away from, well, we had 6 days of straight gains and the potential that US stocks could enter bull market territory, but that winning streak now seems to be well and truly snapped. Well, let's get a little bit more on that CNN report that Israel may be preparing to strike Iranian nuclear facilities. Bloomberg's Michael Heath has been following this for us. Michael, details thin on the ground at the moment. Markets already moving, though. What can we say with certainty?
Yeah, well, I mean, CNN's reported that, several US officials telling it that they've seen indications, both through public information and privately, that Israel may be, as you mentioned, preparing to strike Iran's nuclear facilities. I mean, look, it's an interesting report because it looks like CNN's been told this rather than them breaking it as such. So it sort of looks more like a potential signal here. Whether it's the US using Israel as a stalking horse to put pressure on Iran. We know they've been having talks which sort of seem to have been hitting an impasse. The US wants Iran to abandon enrichment, any nuclear enrichment that can potentially be used for nuclear weapons or civilian purposes. Iran says it's within its rights to enrich uranium for civilian purposes, and it's never had any intention of building a nuclear weapon. So, you know, this is an age-old thing. And another issue that's been raised in the CNN report is that Israel is sort of worried that the US might accept a weak deal. We know President Trump scrapped his predecessor, Trump 1, scrapped President Obama's deal with Iran. So, you know, Israel does want to, you know, this is an existential threat to Israel potentially. The other issue, though, as well, is that we know last year Israel, during that extraordinary situation where we had tit-for-tat strikes between Iran and Israel, that it knocked out Iran's air defences. And also, you know, we've seen Hezbollah sort of dismantled to some extent, Hamas under pressure. So Iran's proxies have all been pushed back. So Iran is uniquely vulnerable at the moment. So there would be, you know, if Israel was going to be moved, the window is sort of there, and that's what the US is thinking too in terms of negotiations. But the sort of important issue here is that Israel can't probably do this seriously in terms of setting back or getting rid of Iran's nuclear program without US assistance. It needs refueling help and it needs bunker-busting bombs. I mean, Iran's nuclear facilities are buried deep in the ground or in mountains, and it doesn't have the weaponry to deal with that. So that's sort of is why it seems like, unless it's got the US behind it, this is unlikely to happen, because any Israeli strikes would only set it back briefly. It's not going to be a game changer there.
I want to get to the market reaction in a moment when Garfield Reynolds talks with us also about this, but there's plenty of other geopolitical news flow at the moment as well, including that the US looks like it might be, well, there's unwilling to put more sanctions on Russia, worried that Russia could walk away from the negotiating table with Ukraine. I mean, one has to ask, would that matter at this point? Is Russia even at the table?
Yeah, this is Secretary of State Marco Rubio saying that they don't want to, almost like they don't want to upset Russia with more sanctions. I mean, it's a specious argument. 25 years of President Vladimir Putin's regime shows they deal with force, they deal with power, they don't deal with goodwill. Okay, that goodwill is viewed as weakness, and that's the only way they'll interpret this. I mean, this would elicit almost laughs in Moscow, you'd imagine, because they've had so many sanctions on them, and they're probably willing to take more sanctions. But the idea that it would make them more flexible, reasonable, if the US holds off like that it's just not a serious argument, really. So Russia is obviously a huge oil exporter as well there when we're talking about the markets. But yeah, I mean, it's Russia will talk to the US either way, because the US is, a potential game changer there, and it wants to keep the US on side, because the way that US has been backing away from Ukraine suits Russia's purposes perfectly. So it's almost like, you see from all elements of the Trump administration, they're sort of walking into, I don't want to say Russia's trap, but they're certainly benefiting Russia in the way they're going about this.
All right, Bloomberg's Michael Heath there. Let's get to Garfield Reynolds now, who leads our Markets Live Asia coverage. Garfield, just want to pick up on the oil movements that we've seen today, as Michael was describing Israel perhaps preparing to strike those Iranian nuclear facilities. Oil prices rising, but how sustainable does that move look, really, when you consider if Iranian barrels did come to the market, they would be coming to a market already dealing with oversupply questions?
Well, I mean, that's just it, though. We've got an oversupply. So if there was, a strike that, I mean, one thing that perhaps traders are looking at is factoring in the idea that an obvious way for Israel to damage Iran would be also to damage its export infrastructure. So that's the sort of thing. And you would also expect that the Houthis would revive their attacks on shipping through the Gulf, through the Red Sea. So you've got the potential for disruption to supplies. Yes, there's too much supply is precisely the problem. So that helps to explain the oil spike. It's also something of a knee-jerk reaction. To some extent, it feels a little bit overdone, given, as Michael was outlining, that there are plenty of reasons to doubt just how serious these plans for an attack are. But on the other hand, it is an acknowledgement that perhaps people have been sleeping a little bit on the deterioration in the overall geopolitical situation in the Gulf, where you've got the Iran-US talks at an impasse, you've got the Israel-Gaza aid situation, which has had the Qataris fretting, amongst others, overnight. So you have a little bit more geopolitical uncertainty than had perhaps been reflected in the oil price. So now that price is moving to reflect that geopolitical uncertainty with a little bit more accuracy, might be the thought.
I want to move on to another large macro factor as well, and that is the large, beautiful tax bill working its way. I'm not sure what it's being called exactly at the moment, but we are seeing markets positioning around this, particularly when it comes to bonds. What message is the market sending about this bill?
Well, I mean, the market's also been a little bit, we're talking about being woken up about the complacency regarding the Middle East. The Moody's report, the decision to downgrade the US on Friday, is also helping to wake up some level of complacency amongst investors. And the concern is with this bill that almost whether it gets passed or not, it's heightened the realization that this administration is going to lean into bigger deficits and therefore into greater issuance. And that means that the yields are likely to go up because you're going to get too much supply for the demand that there is. You've also got, yet again, the uncertainty emanating from the Trump administration about what's going on. But I thought it was particularly notable, the bill hasn't got what it needs in the House, and President Trump has been pushing back against hardliners who are saying they would only pass the bill if it cuts more out of Medicaid, and he says don't touch Medicaid. So that kind of tells you all you need to know. If the bill passes, it is going to lean more on the cutting revenue side of things, tax cuts and so on, and on some of the spending increases that it wants, and much less on attempts to trim spending in order to reduce the hit to the deficit. So whatever might be said officially out of the White House, the market is going to look at this as signaling more supply is coming. And that's a particularly dangerous setup, because one of the things that's driving by now the concerns about the US budget position is the increase in interest costs. So the higher yields stay, the more danger there becomes that the budget really gets out of hand. And if you look at some of the calculations being made about where the deficit will go in response to the bill as it is currently structured, those actually assume interest rate costs that are lower than we now know they're likely to be. So again, you've got this potential for a spiral getting out of control in what's going on with the US budget. That's helping to drive those yields up. You've got the 30-year yield hovering around that 5% level. That's taken on a fair bit of psychological weight. That's where moves higher in the 30-year yield petered out over the last couple of years. So that's at the moment, it's a simmering concern, but that could readily really start to pop.
All right, Garfield Reynolds there, who leads Markets Live coverage. Well, let's get to Tesla shares. They closed higher in New York after CEO Elon Musk said he's committed to continue running the company for at least 5 years. Musk also took aim at the Delaware judge who has twice ruled against his massive pay package. He spoke to Bloomberg's Michelle Hussein at the Qatar Economic Forum in Doha.
Tell me then how committed you are to Tesla. Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all?
Well, no, I might die.
Okay, short of that.
I can't be CEO if I'm dead, so there's a slight amount of time.
Does that mean that the value of your pay doesn't have any bearing on your decision?
Well, that's not really a subject of discussion in this forum. I think obviously there should be compensation for, if something incredible is done, that compensation should match that something incredible was done. But I'm confident that whatever some activist posing as a judge in Delaware happens to do will not affect the future compensation.
This is the judge who twice struck down the $56 billion pay package that was awarded to you. I think the value on the current value of stock options. Yeah.
Not a judge. The activist who is cosplaying a judge in a Halloween costume.
Okay, that's your characterization. I think
yes.
On the current value of stock options, I think the actual
justice according to the law.
On the current value of stock options, I think the value of that pay package stands at about $100 billion. Are you saying you are relaxed about the value of your future pay package? Your decision to be committed to Tesla for the next 5 years, as long as you are still with us on this planet, is completely independent of pay?
No.
It's not independent. So pay is a relevant factor then to your commitment to Tesla?
A sufficient voting control such that I cannot be ousted by activist investors is what matters to me. And I've said this publicly many times. But let's not have this whole thing be a discussion of my alleged pay. It's not a money thing. It's a reasonable control thing over the future of the company, especially if we're building millions, potentially billions of humanoid robots. I can't be sitting there and one day get tossed out by, for political reasons, by activists. That would be unacceptable. That's all that matters.
That's Tesla CEO Elon Musk speaking with Bloomberg's Michelle Hussein at the Qatar Economic Forum. We have more ahead on the Asia trade. This is Bloomberg. President Trump is said to be growing frustrated with demands to significantly boost the cap on the state and local tax deduction. This is known as SALT, and this is signalling a deadlock as Republicans aim to quickly pass a giant tax cut bill. For more, let's get to US Treasury reporter Daniel Flatley joining us now. So, Daniel, what exactly is the argument around the SALT cap, and is there any progress on getting a deal moved forward?
Well, Paul, this is one of a number of sort of sticking points that we're looking at right now with this negotiation over this tax bill, which is really important for President Trump's agenda. It's one of the things that he has to get done, and he has to get it done this year in order to really kind of get the three legs of the stool, as Treasury Secretary Scott Bessent would describe it, in place. And so what's holding things up right now are these discussions over SALT taxes, or state and local tax deductions. And these are really important for legislators in urban areas, heavily populated areas like New York State or New York City. And it's one of the many sticking points. There's another one that has to do with debt and deficit reduction. But this is kind of emerged as a really important piece of the puzzle, because a lot of these Republicans that are negotiating with Trump or talking to Trump about the state and local taxes are more moderate Republicans who could vote and want to vote to extend the tax cuts, but because of this very important thing for their local constituencies, it's kind of holding things up at the moment.
So, Daniel, you're there in Canada to cover the G7, and the last time the G7 met in Canada, we were treated to that extraordinary photograph of then German Chancellor Angela Merkel standing over a defiant President Trump with his arms crossed. So what can we do this time what can we expect to see this time to find areas of cooperation rather than confrontation with the US?
Yeah, I mean, it's a great kind of touch point for how the rest of the world, is approaching these talks, or I should say the six other nations in the G7 are approaching these talks with the U.S. Canada is hosting the G7 this year. I'm here in Banff, in Alberta, Canada, for the finance ministers meeting. Delegations are coming in from the various countries to talk. And I just got back from a press conference with the Canadian finance minister, and it was very clear in his remarks that there are some areas of disagreement, but they're working very hard to focus on the areas where the seven nations and the EU have agreement. And one of those is on Chinese overcapacity or overproduction, whatever you want to call it. But basically this idea that China is producing a number of goods and selling those into some of the more developed nation markets at lower prices than what might otherwise be the case. So that was one, potentially restricting some lower cost goods from coming into the country, or how they come into the countries of the G7. Those are goods that Chinese companies like Shein or Temu have really made their business models on. So, it's kind of some areas of agreement there. But one thing that he did say that I thought was interesting was he did acknowledge that the Canadian finance minister did acknowledge that there were some tensions over tariffs, and that they do want to kind of get, quote, back to basics and try to get back to a more sort of free trade, market-based, global trading environment. And so I think that they will find some areas of agreement with the U.S. on China and sort of this idea of opening other markets to the G7, but maybe not so much on U.S. Tariffs on Canada, among other things. So, it's going to be kind of an interesting week, although I think people are trying to kind of keep tensions at a sort of a low simmer as much as they can.
All right, Bloomberg's Daniel Flatley there in Banff for the G7 meeting. We have more ahead on the Asia trade. This is Bloomberg. Time now for morning calls ahead of the Asia trading day. Goldman Sachs sees US big tech outperforming again this year, driven by robust earnings growth. Their equities team, led by David Costin, says the valuation premium of the Mag 7 stocks relative to the benchmark index at the lowest since 2019. Still, they expect a smaller outperformance compared with recent years, giving a narrowing differential in analyst profit estimates. Morgan Stanley says mergers and acquisitions in the US banking sector should increase in the second half of the year. Analysts see activity picking up as recession fears fade and the regulatory landscape continues to shift. The industry's seen fewer deals than usual since 2021. There's been about 100 to 150 announced transactions per year. Hedge fund billionaire Ray Dalio says the Fed should not cut interest rates right now, with policymakers facing heightened economic uncertainty. We also asked the Bridgewater Associates founder for his views on rising US debt and the recent Moody's downgrade.
For me, it's been like I'm on a boat, and everybody on the boat, we're agreeing that if we don't make this change, we're going to hit the rocks. And then everybody's arguing about how to make the change, and they won't make the change. And so we're headed for the rocks. That's the feeling.
You know, you mentioned supply-demand dynamics. I'm sure everybody in this room had seen that Moody's downgraded the United States just a few days ago. Bloomberg reported this morning that you have funds across the world that are talking to the regulatory authorities to make sure that they don't feel the pressure of that. There are holders of treasuries, and this might become more difficult in the future. How big of an issue is the downgrade?
The downgrade is an understated indicator. Of course, there are benchmark and credit issues, but when they downgrade it, they don't reflect how bad the debt is. They reflect the probability of it being defaulted on, but they don't reflect the fact that the more likely scenario is that money is printed to pay for the debt. And so if you have a situation such as when Japan had its currency go down and its interest rates lower, and you lost about 3% in the currency and about 3% a year in the depreciation or the interest rate differential, it's a negative situation for the bonds that's being actually understated by that rating, because it doesn't take into consideration the more likely path of devaluing money. And that is why we're seeing a shift in the supply demand. Also, there are worries about sanctions. There are other issues that enter into the supply demand picture. So I would say the situation is more serious, even in my estimation, than it is conveyed by the rating.
That's Bridgewater Associates founder Ray Dalio there, speaking with our colleague Sonali Basak. And a reminder of our exclusive interview coming up with JP Morgan CEO Jamie Dimon. That's 11:30 a.m. Thursday, Hong Kong time, late Wednesday evening in New York. Let's take a look at how havens are tracking. We do, of course, have this report that Israel may be preparing to strike Iranian nuclear facilities, seeing the oil price tick up, gold futures higher as well. This is Bloomberg. Apple is preparing to let developers outside the company write software using its AI models, and the move aims to spark creation of new apps and make its devices more enticing. It's also part of a broader attempt by Apple to catch up with the competition on generative AI. For more, Bloomberg senior tech editor joins us from San Francisco. Can you give us a sense, perhaps, of just how important this move is for not just developers, but also for Apple in terms of, as mentioned there, helping Apple close the gap in generative AI?
Well, I think this is probably more important in terms of the potential it offers, because I'm not exactly sure what is expected to emerge from it in terms of specific applications that might be created. But I think it gives developers a chance to dig into Apple's tools and maybe create something unexpected, maybe create a bunch of new apps that some of which catch on, some don't, but just have a more, a wider variety of options out there of software that takes advantage of Apple's AI models.
So we're expecting this to be announced at the WWDC conference coming up. There's been no official word from Apple as yet. Is this going to be it in terms of major announcements, or could we anticipate something else as well?
There's going to be what we're expecting is maybe the highlight might be a overhaul of all their device operating systems. They're essentially going to make the operating systems, which right now, some of which work fairly differently than others, resemble each other a lot more, be a little more cohesive, and have a similar look. And that look is expected to look a little bit like what the Vision Pro headset OS looks like, which that product hasn't been a hit, but it has kind of been a technological breakthrough of sorts in many ways for Apple, and I think they feel like there's some lessons that they picked up there that they can apply to the rest of their software.
Yeah, what sort of apps could we potentially see developed if developers get more access to Apple's AI tools?
I mean, it's a good question. I think the issue is that the current apps on Apple Intelligence aren't necessarily that compelling. I mean, there's a Genmoji app that lets you create custom emoji, but the results, if you've played around with it, aren't always very impressive. And there's an image playground app that's sort of similar. It's maybe fun for a couple of minutes, but it doesn't really keep you engaged with a phone. I think if some developer can come in and figure out a way to use this technology in a way that maybe we wouldn't even necessarily occur to us at this moment, then that could be something really good for Apple, and hopefully maybe recreate some of the excitement of the early App Store. Back, we're talking 2008, where things were just, there's a lot of creativity, and Apple kind of unleashed this wave of new apps.
All right, Bloomberg senior tech editor Nick Turner there. Well, OpenAI, SoftBank and Oracle have embarked on an ambitious journey to build one of the largest AI data centers in the world. In a new episode of The Circuit with Emily Chang, she speaks to Sam Altman and Masayoshi Son about how the $500 billion Stargate initiative came together. Here's a preview.
How did you get to talking with Masayoshi Son and Larry Ellison, and how did you all come together?
I did 2 kind of long trips around the world, and a lot of it was to talk to developers and governments, but a lot of it was also to just really try to get my head around the supply chain. On one of those trips, I met with Masa, and we got to speaking about what it would take to do compute at this kind of scale.
Hi, Masa. It's so nice to see you. What conversations did you have with Sam that led to Stargate?
Well, we have a shared vision of AGI coming soon, and we need compute.
Of all the bets you could make, why this? Why Stargate?
Well, I believe in the vision that this AI, the AGI, will change mankind's life in every aspect. And we are lucky to see this enormous revolution, and I'd like to be part of that. I get excited.
Last month, I came to celebrate your winning and promised that we will invest $100 billion. And you told me, oh, Masa, go for 200. Yeah. Now I came back with 500.
Explain the math to us. How does it all add up to needing $500 billion?
Well, that covers the capacity we think we need for the next few years, given our growth projections. The interesting question is if we knew how to get $1 trillion right now, which we don't, would we be able to deploy that profitably in the next few years? And I'm not sure about that, but I feel confident we can make $500 billion of value back.
And you can catch full conversations with OpenAI CEO Sam Altman and SoftBank Group CEO Masayoshi Son on The Circuit with Emily Chang. Season 3 premieres Thursday on Bloomberg Television, or you can stream it on Bloomberg Originals. Let's get the latest now from the corporate front. Alphabet's Google will offer its AI mode in search to all US users as it tries to keep pace with new rivals. Google has been making big changes to its search engine to ensure that its core product remains relevant. And that's as decades of search dominance has come under increasing threat from AI chatbots.
Models into your hands and our products ASAP. And so we are shipping faster than ever. We have announced over a dozen models and research breakthroughs and released over 20 major AI products and features, all since the last I.O.
CATL's founder and chair, Robin Zhang, is pushing back on US accusations that the company poses a national security threat. Zhang told Bloomberg the company has never sold any of its products to the military or for warfare. He was speaking in Hong Kong after the stellar debut of CATL's secondary listing. The US Defense Department has added the Chinese battery giant to a blacklist of companies with alleged links to the PLA. Asus co-CEO Samson Hu says the Taiwanese PC maker may have to raise prices by about 5 to 10% in the US due to tariffs and costs tied to supply chain diversification. Speaking at Computex 2025 in Taipei, Hu told us how Asus is managing trade risks.
Our supply chain strategy is built around flexibility and diversification. So we are working very closely with our manufacturing partner to ensure that we have production capabilities around the world, including the US. That's very important. And that's why we also very carefully and very closely monitor the latest situation about the tariff policy and assess the impact to our supply chain.
What's the level of tariffs that you anticipate as a business? What's the base case scenario that you see?
I think, the recent US-China trade deal announcement is a positive development. So I think we are somewhat confident about the future of the global trade deal stability. However, I think the tariff policies still continue to shift.
Earlier this year, we had an interview with Asus, and you were talking about sending products to the US to get ahead of the tariffs in the fourth quarter of last year. Where are those inventory levels now, and how much of a buffer do you have as well?
Okay, that's an interesting question. Actually, we prepare those inventory levels since last quarter four. And usually we build the inventory level between 3 to 6 months, depending on different product category.
So then how much of a safety net do you have right now? How many months?
Still 3 to 6 months at the current moment.
Yeah. Without having any sort of price changes to your products?
In terms of price, right, you are asking?
Yeah.
To be honest, we expect some price increase, maybe need to pass on to our consumers. Yeah, especially for those products reliant on effective components. Mm-hmm. And at the same time, you know that we have long been diversifying our manufacturing footprint to address the tariff concern. And naturally, this will also bring extra logistic costs. So that's why we have started the price adjustment with our channel partners based on the condition to maintain our margin balance and based on the market acceptance.
So what's the increase you're expecting then on the price, and which products as well do you think?
The price increase in really vary quite a little bit depending on different product category.
Could you give sort of a range then of the percentage that you're expecting to increase?
It highly depends on the extra logistics cost and the possible tariff rate going to import. So usually it's 5% to 10%.
5 to 10%
yes.
Price increase, okay.
Yes.
And is that just for consumers in the US, or do you need to also apply this globally to try and offset?
Only in the US.
Let's talk about the demand for AI servers or AI PCs as well, because these are two different business lines for you. What are you seeing right now in terms of customer or business appetite?
Well, you're asking about the demand of AI, okay. We continue to see strong demand for AI. That's because AI is no longer optional for business, since it really helps them to improve operation efficiency and to stay competitive.
That's Asus co-CEO Samson Hu speaking with our tech reporter Annabelle Drewlers at Computex in Taipei. Let's take a look at how US Treasury futures are tracking at the moment, of course, in the context that we're hearing from a lot of Fed speakers right now. Mary Daly, Raphael Bostic and Beth Hammack all speaking on a panel at the moment and sticking to the line. Don't expect any movement anytime soon. Mary Daly saying that the Fed remains highly sensitive to the risk of inflation. Hammack saying that the Fed is well positioned to be patient, and Raphael Bostic saying there is no recession in the outlook either, all adding up to no move in the near future from the Fed. In terms of futures, we've got a 20-year auction coming up on Wednesday in the US, $16 billion worth of 20-year debt going up for grabs. This is the first auction of longer-dated notes since that Moody's downgrade on Friday, so that should be an interesting auction to watch. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how some of the key commodities we watch are tracking at the moment. We've got the gold price pushing a little bit higher. It's given up some of the gains that we've seen earlier. Crude prices pushing higher as well. The key factor here seems to be a report that we received just a couple of hours ago that Israel may be preparing to strike Iranian nuclear facilities. We don't have any confirmation of that, but the market's selling first, or in the case of gold, buying first. And then asking questions later. Well, joining us now is Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. Samantha, thanks so much for joining us. I know it's difficult to react to that sort of news, but in terms of these reports that we get that there might be a strike on Iranian nuclear facilities at the same time, Iran itself isn't even sure if sanctions are going to be tightened or loosened around supply. How confident can you be in making price forecasts around oil at the moment?
Yeah, I think that's why we have to consider scenarios. And when it comes to these types of risks, we like to bring it down to potential disruption of supply. In the case of Iran, Iran has increased its supply by just about 1 million barrels a day over the past couple of years. And if you remove 1 million barrels a day of production from Iran, this could represent an upside of about $8 a barrel to the crude oil price. Now, that said, we know that the rest of OPEC has a lot of spare capacity. So if we think that even in the case of a disruption of supply, that would ultimately be offset by an increase in supply from the rest of OPEC, then that impact on price tends to be moderated over time.
And can we also consider the potential factor of US supply and demand as well? I mean, obviously, President Trump is on the record saying he wants low oil prices, but he also wants strong US oil domestic production. Is it possible to have both?
So when we talk to US oil and gas producers, they react to market prices more than anything else. And yes, if you have WTI prices below $60 a barrel, this is a big deal for producers. And it's not just me saying, we just have to look at the rig count in the US, and oil drilling has come off significantly since the year has started.
I mean, another factor for the reason for these weak prices we're seeing are concerns around demand in China. And it's not just demand for oil. I'd be interested in your views on Chinese LNG demand as well. Longer term, can you see it picking up? What's your outlook for perhaps not this year, but for the coming years, maybe even the coming decade?
Yeah, that's a very good point. Year to date, China demand for LNG has been exceptionally low, even comparable to the lockdown year of 22. So I think there were a few different factors contributing to that. It was a very mild winter. It was also a period when China was getting a lot more pipeline natural gas flows coming from Russia. So the more pipeline gas you get, the less LNG you need to purchase. Also, the other aspect of the market that we notice is that power generation growth is growing at a lower pace than last year. So all of these factors have contributed to a little bit of weakness in demand of natural gas. That said, when we look at what drives that demand in the first place, it is primarily industrial activity. So to the extent that the US-China tariff de-escalation can support industrial activity for manufacturing and exports, this can support LNG demand sequentially through the end of the year. And to your point, when we look longer term, China is still a market that where we expect to see significant growth in power generation. So even though China does not rely on natural gas as its primary source of power generation, it is a complementary fuel. So we definitely expect natural gas demand to continue to grow in the region for many years to come.
And can we talk a little bit about the supply picture for gas as well? Because we've got a number of energy or export projects coming online in the US and Qatar. Much like oil, could you see the potential for the gas market to move into oversupply as well?
Absolutely. We expect that US and Qatari supply, as you pointed out, will drive this market into a significant oversupply. We think that will be very visible starting in 2027, but becoming larger and larger over the rest of the decade into 2030. Also, we have to think that having cheap natural gas for a few years, consecutive years, can also plant the seeds for additional demand growth. So we look at this oversupply not as the new normal, but as a cycle. And after a while, you end up incentivizing enough demand to normalize the market, but not until we get into the next decade, in our view.
I just want to touch on the situation in Europe as well, which of course traditionally relies on supply from Russia. What are your expectations around European gas prices for the rest of the year? And could restocking efforts this summer potentially drive prices higher?
Yeah, we think that prices around their current levels can balance the European market. The reason why I say this is what we were watching closely is how much LNG imports Europe can get at different price levels. So at current price levels, Europe is getting the amount of LNG imports that it needs to manage storage. But that also means that there is not a lot of downside from here. We think that prices have to stay at current levels or slightly above in order to kill LNG demand outside of Europe. If LNG gets too cheap this summer, you tend to see other buyers picking it up, and then you have lower availability of supply for Europe. And Europe cannot afford to have that this summer, given how low storage is.
All right, Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. Thanks so much for joining us. We've got some breaking news out of Japan. There's trade numbers for the month of April. Of course, this is the month that included Liberation Day in the US, as it has become known. Exports still expanded 2%, although that was a slowdown from the 3.9% growth that we saw the month prior, and it did fall short of estimates as well. Imports contracting at 2.2%, although that wasn't as steep a contraction as anticipated. The trade balance in Japan, though, falling into deficit, 115 billion yen. We were expecting to see a surplus of 215 billion yen. The yen, meanwhile, little change, 144.31. More ahead on the Asia trade. This is Bloomberg. The options market is flashing signals that the recent rally in Japan's stock market is likely to fade. Senior stock reporter Hideyuki Sano joins us now with more from Tokyo. So Hide, why are investors not buying call options?
Good morning, Paul. I think that reflects the suspicions about how sustainable the rally has been. if you look at the Nikkei average, it has risen more than 20% from a trough hit in April. So that is quite an achievement so far. But on the other hand, if you look at option markets, some analysts are startled by a lack of demand for call options. If you look at the previous episodes of bull market in Japan, for instance, in May 2023 or January 2024, when the market rallied, investors also bought call options because it is a very nice way to bet on the rise in the market. But this time, there's almost absence of strong demand for calls, and analysts say that is a sign that investors still not sure how far the market can go, especially when the earnings are not giving a clear-cut picture on the outlook.
Haidi, very quickly, any more interest in put options in that case?
Yeah, the interesting point is put demand remains strong, so that seems to suggest that investors are still worried about downside risks, and especially if you look at the Nikkei Volatility Index, it seems to show a semblance of calm sentiment, but the one point to note is that the index covers just 1 month period. And if you look at longer volatilities, like 3 months volatilities, actually investors are still nervous about what could happen after the suspension of US tariffs.
All right, Bloomberg senior stock reporter Hideyuki Sano there. Let's check some of the stocks to watch when trade opens in Australia, Korea and Japan shortly. Westpac, keep an eye on that, reportedly planning to axe more than 1,500 jobs. That's its biggest downsizing in a decade. The AFR citing sources saying CEO Anthony Miller finding ways to cut costs. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And Paul, we've been talking about this idea of market complacency and whether this fallback on, everything's going to be okay when it comes to trade has gone too far. We've got the sell-off to contend with, also a number of rising geopolitical risks.
Yeah, absolutely. We did get that report today that Israel perhaps preparing to strike Iran's nuclear facility. Nothing's happened yet, apart from the oil price moving higher and the gold price as well. But yeah, certainly plenty to watch.
Yeah, nothing sort of one-way street when it comes to this market, right? Let's take a look at how we're shaping up as we head into the start of cash trading across major markets here in Asia. This is a picture as we get the start of trading in markets like Japan, of course, as we continue to watch whether we see that much impact when it comes to the yen in particular, given we do have these geopolitical concerns that move in oil on that Israel-Iran report as well. We've also got some commentary from the Fed as in addition to that, saying that the tariffs situation will still likely weigh on jobs as well as the growth situation. This is coming from the Fed, Reserve Bank of St. Louis President Alberto Musalem. They're talking about still that impact of tariffs, even as we have something of a pause with some major trading partners, including, of course, China. But this is the picture as we get into the start of trading. The first couple of minutes or so looking like we'll see a positive open here for Japan. The Nikkei 225 up by just about 1/4%. The Topix also sitting a bit high by 0.4%. Dollar yen there seeing some backs, a little bit of a back step there. 144.20 or 30 is where we're trading at the moment. Watching also JGBs pretty closely at the moment, given that we've been watching Treasury so closely. That 10-year yield at 5% is what traders have been eyeing. The sell-off, particularly when it comes to longer-term US bonds, has been souring that risk-on mood. The concerns about US government debt and deficits fueled by the tax cut bill and the ongoing negotiations there are really sort of front and centre at the moment. We're seeing that carry through when it comes to regional sovereign bonds as well. Switching out the board to take a look at Korean stocks at the moment as we get trading underway in that market there as well. This is a Kospi with upside about 0.6%. We're also seeing some of those tech stocks doing quite well there as well, 0.7% so far. I've been watching that sort of first 20 days of May trade data that's in focus today. And this is what we're seeing when it comes to those numbers as well, given they are such a sort of barometer when it comes to the global trade situation. We're seeing imports falling by 2.5% year on year, the 20-day trade deficit coming in at $253 million US dollars. But key is that export number, a decline of 2.4% year on year. This is sort of very much a sort of canary in the coal mine when it comes to the implications for global trade. So we'll be watching that very closely.
Well, let's take a look at how we're tracking here in Australia. We've been up and running for a couple of minutes now. A staggered open, of course, so hard to get a read on things, but we're just a couple of points higher right now. We will be keeping an eye on some of those big names in the banks. We did, of course, get that 25 basis point rate cut from the RBA yesterday, as widely expected, and all of the banks swiftly passed that on to mortgage holders. But one bank will be watching, Westpac, announcing that it's going to cut 1,500 jobs. That's the biggest redundancy round in 10 years as the bank embarks on a cost-cutting drive. Westpac, though, starting with a W as it does, that's probably not going to move until about 8 minutes past. Haidi mentioned the bond space as well. We've got yields a little bit higher at the moment. It's going to be an interesting 24 hours for bonds because, as Haidi noted, we've got not a lot of interest in the longer end of the curve there, and we do have a 20-year auction on Wednesday US time worth $16 billion, and that's going to be the first auction of longer-dated notes that we've seen since Friday's downgrade by Moody's of the US. Heidi.
Yeah. Tesla shares we're watching, Paul, closing higher in New York after CEO Elon Musk said he's committed to continuing running the company for at least 5 years. Musk also took aim at the Delaware judge who's twice ruled against his massive pay package. He spoke with Bloomberg's Misha Hussain at the Qatar Economic Forum in Doha.
Tell me then how committed you are to Tesla. Do you see yourself, and are you committed to still being the chief executive of Tesla in 5 years' time?
Yes.
No doubt about that at all.
Well, no, I might die.
Okay, short of that.
I can't be CEO if I'm dead, so there's a slight amount of time.
Does that mean that the value of your pay doesn't have any bearing on your decision?
Well, that's not really a subject of discussion in this forum. I think obviously there should be compensation for, if something incredible is done, that compensation should match that something incredible was done. But I'm confident that whatever some activist posing as a judge in Delaware happens to do will not affect the future compensation.
This is the judge who twice struck down the $56 billion pay package that was awarded to you. I think the value on the current value of stock options. Yeah.
Not a judge. The activist who is cosplaying a judge in a Halloween costume.
Okay, that's your characterization. I think
yes.
On the current value of stock options, I think the actual
justice according to the law.
On the current value of stock options, I think the value of that pay package stands at about $100 billion. Are you saying you are relaxed about the value of your future pay package? Your decision to be committed to Tesla for the next 5 years, as long as you are still with us on this planet, is completely independent of pay?
No.
It's not independent. So pay is a relevant factor then to your commitment to Tesla?
It's sufficient voting control such that I cannot be ousted by activist investors is what matters to me. And I've said this publicly many times. But let's not have this whole thing be a discussion of my alleged pay. It's not a money thing. It's a reasonable control thing over the future of the company, especially if we're building millions, potentially billions of humanoid robots. I can't be sitting there and one day get tossed out by, for political reasons, by activists. That would be unacceptable. That's all that matters.
That's Tesla CEO Elon Musk there, speaking with Bloomberg's Michelle Hussain at the Qatar Economic Forum. Let's get into breaking news out of the US. We're hearing that the Department of Justice has opened a probe into Andrew Cuomo, who's, of course, a front-runner in the New York City mayoral race. The Republicans are accusing him of lying to Congress about decisions that he made during the coronavirus pandemic when he was governor. This is according to two people familiar with the matter. And of course, interesting timing this because the Trump administration has just ended a criminal case against the current mayor, Eric Adams, who is, of course, Cuomo's rival for the mayoralty. And Cuomo currently leading the Democratic primary field in the polls. So Andrew Cuomo there now under investigation for some of the decisions that he made during the coronavirus pandemic.
Yeah, following that very closely. And Paul, we're also following some of the geopolitical implications that we're seeing across energy markets at the moment, right? Take a look at what we're seeing when it comes to trading in oil at the moment. This is all on the back of one CNN report that US intelligence suggests Israel is making preparations to strike Iranian nuclear facilities. That jump that we see on in the trading when it comes to crude potentially just shows how on edge traders already are, and that perhaps a further stronger price swings can't be ruled out either. This kind of goes to the apparent breakdown of talks between Taiwan and Washington as well, with the Supreme Leader saying that the position on Iran when it comes to enriching uranium had already dampened concerns that sanctions on the OPEC Plus producer would be eased. So this really complicates the picture when it comes to potential supply in a market already facing the prospect of a glut later this year. So we're seeing Brent at the moment sitting a little bit higher. Bloomberg intelligence saying that a deal between the US and Iran could sink that price to $40, particularly in light of that quota compliance backdrop. More ahead on the Asia trade. This is Bloomberg. Well, CNN is reporting that US intelligence has learnt that Israel is making preparations to possibly strike Iranian nuclear facilities. For more, let's bring Bloomberg's Michael Heath, and we're seeing that reaction across oil markets. What do we know, and what's the backdrop to this reporting?
Yeah, well, so CNN reported, and it's citing several US officials and public information, private information and intelligence. And the basic thing is that Israel has been sort of moving air munitions and undertaking Air Force exercises kind of thing. But the backdrop of this, obviously, is there's been the US-Iran negotiations on trying to prevent Iran acquiring a nuclear weapon, which has been ongoing for some time. That's sort of hit something of an impasse because the US, President Trump seems to have directed that the US position is that Iran can't be doing any enrichment. Iran says, well, look, under the United Nations Charter, we're allowed to do that for civilian purposes. Iran maintains it's never had any intention of getting a nuclear weapon, but the same UN agencies suggest that some of its enrichment is for that. So the idea then is that Israel sort of can't allow Iran to have that. It's an existential threat for Israel. And last year when we had those extraordinary tit-for-tat strikes between Israel and Iran, Israel actually knocked out Iran's air defences, and it's also degraded this sort of ring of fire of resistance groups that it finances. So it's in a weakened position. The interesting point here sort of is that it's not like CNN sort of broken this. It seems that these people have spoken to them. So it's sort of almost like a message that's being sent that either the US is aware that Israel's up to something, or the US wants to exert pressure on Iran that Israel's ready to go here, because for Israel to really do some damage to Iran's nuclear arsenal, its nuclear program, it needs US munitions. So they need to do this together.
Let's turn to one of the other enduring geopolitical conflicts, and that is, of course, the Russia-Ukraine crisis. Marco Rubio seems to be indicating that the US doesn't really want to impose more sanctions in case Russia walks away from negotiations. But to what degree is Russia meaningfully engaged anyway? Would it make a difference?
Yeah, Paul, I mean, it's a pretty specious argument. And to be honest, Marco Rubio, has a Secretary of State, has a pretty good history on this in terms of sponsoring sanctions bills and wanting to ratchet up pressure on Russia before he became the Secretary of State. It sounds sort of more like President Trump talking there and him reflecting that. It's sort of, again, the Trump administration sort of walking into Russia's playbook here, that 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 sanctions might make Russia not talk to them. Well, it's not going to make any difference whatsoever. The US is the big dog, so to speak, here, and Russia's main thing is that it wants the US to stop supporting Ukraine and to sort of walk away from the conflict, which President Trump has been giving every indication he's going to do. So the notion that putting more sanctions on Russia would stop them talking to the US or would have some sort of negative effect on negotiations just doesn't hold water.
All right, Bloomberg's Michael Heath there. Well, President Trump is said to be growing frustrated with demands to significantly boost the cap on the state and local tax deduction, which is known as SALT. This is signalling a deadlock as Republicans aim to quickly pass a giant tax cut bill. So for more, let's bring in senior editor Bill Ferries. Bill, can you give us the latest on this deadlock over SALT? Is there any progress to getting it sorted out?
Well, the president visited Republicans on Capitol Hill yesterday to try to rally them to just get totally behind this big, beautiful bill, as he calls it, that has his signature tax cut legislation. It's really his biggest legislative priority for the entire year. And it doesn't sound like he's made much progress. The big challenge here is, of course, that Republicans can only afford to lose 3 votes on the entire tax package out of about 218 members in the House side. So any little faction can have an outsized influence at this point. A lot of the opponents or the lawmakers looking to increase this tax deduction are from very high tax states. We're talking about New York, New Jersey, Connecticut, California. They and their constituents have been frustrated since the last Trump tax cut in 2017 about the very low, in their mind, deduction for state and local taxes. On the flip side, you have conservative opponents who are looking to make big cuts in Medicaid, and that's also an issue that's going to cause problems for this bill down the road. Remember, this is just the House legislation at this point. It still needs to go to the Senate. The Senate is going to have their own red lines, so there's a lot of negotiations to go forward before this bill really ever has a chance of getting to the president's desk.
Bill, what's the tone that we're hearing from the G7 in Canada, particularly pertaining to sort of further expectations for talks or détente on trade?
Well, President Trump's kind of modus operandi here is to not deal with blocs. He wants to deal with countries bilaterally. We're in the middle or just passing the middle now of that 90-day pause on reciprocal tariffs. I think there's a lot of questions about how many deals are going to get struck and whether the deals whether this pause might get extended. But I think the trade talks are going to be a major issue at G7. I mean, frankly, we've got a lot of other big things going on as well with the war in the Middle East and the situation with Russia and Ukraine. I think that's all going to be the key issues dominating that forum.
Right, Bloomberg's Bill Ferries there. Other stories that we're following. President Trump says a missile defense shield called Golden Dome will be operational by the end of his term. He says the system may cost $175 billion overall, but the Congressional Budget Office says the bill could reach $542 billion over 20 years. Trump has appointed a Space Force general to oversee developments and says Canada wants to be part of the program. The US International Trade Commission has voted to impose duties on imported solar cells. Modules from Cambodia, Malaysia, Thailand and Vietnam are set to be impacted after the agency concluded the imports harm domestic manufacturers. The fees will take effect in June. US companies have long blamed discounted imports from Southeast Asia for making it difficult to build and sell equipment domestically. NHK is reporting that Shinjiro Koizumi has been named as Japan's new farm minister. That follows the resignation of Taku Eto, who set off controversy by saying he's never bought rice. The remark angered consumers who have seen rice prices double in the past year. Prime Minister Ishiba's government is facing some of its lowest support ratings since he took office ahead of an upper house election in July.
Let's get some more when it comes to how we're setting up for markets given all of this turmoil. Joining us now is Hartmut Issel, Head of APAC Equities and Credit at UBS Wealth Management. Hartmut, great to have you with us. What's top of mind for you at the moment? We're seeing that pullback when it comes to risk, these concerns over the long end of the treasuries market and how that's going to sort of portend for trader optimism, and also a lot happening on the front of geopolitics.
Yeah. That is very correct. Nonetheless, we don't think that investors should necessarily leave the markets or anything like that. To the country, I mean, there are also interesting opportunities. We think on the equity side, let's say here in Asia, for example, we still have markets where we see also on the tariff side, for example, certainly progress. I mean, I would certainly mention India here as one. And India, we also think is, even if you leave tariffs out for a moment, it's a market that has come from a sort of mid-single-digit earnings growth, is going into 2 years of double-digit earnings growth. So here's an area that hasn't fully recovered yet since the September high. So we think there's an interesting idea here. We think China, especially the tech side, right, it also can move up a little bit again, and especially now that U.S.-China seem to be on more agreeable terms for now. That could be interesting. And also Taiwan. So, we do certainly see also interesting areas also here in the region.
Yeah, tell me about some of those sort of idiosyncratic opportunities you see in these markets like China, like India, for example.
Yeah, maybe starting with China. So that's interesting. So in China, we think the technology space in general is quite interesting. So on the one hand, of course, we have the internet stocks, and given what happens also with AI, right, this is very clear that there is also, from an earnings point of view, if I compare it with last year, or especially the last few years, right, that looks certainly more promising. In addition, what we also like is in the tech space, right, more and more, we're looking also at the humanoid side of things, right? So there's some of the also EV makers, for example, right, that going into this space. So if anybody of the investors looks also a bit further out, maybe 4 or 5 years or so, right? But this is beginning now. So there's a couple of interesting opportunities. The valuations aren't particularly high in China tech. So this is one area I can think of that that leads us also to believe beyond tariffs, which of course is an important discussion, but there's certainly more to it on the fundamental side.
Hartmut, what's your outlook for the US dollar at the moment? Do you expect this weakness to persist?
We think in a very short term, also given how it has performed already, there could be a bit of a pause. But yes, we do suggest to our investors that then they should look into diversifying a bit more. I mean, not completely leaving the dollar, of course, but diversify a bit more into other currencies. And that over, say, a 12-month point of view, for example, remains in place. So yeah, we do see a little bit more softness coming up for the US dollar. And yeah, arguably also the Fed will be also coming in, but they come more on the later side, right? Others are already there. So yeah, it speaks in favor of a bit more softness over the next 12 months on the US dollar.
Yes, and we've heard from a number of Fed speakers this morning speaking on a panel, just reinforcing this idea that they are in no hurry to ease. What's your timeline for the size and magnitude of Fed easing?
And we think probably maybe September or so, around that time, we believe it's probably going to start. And then maybe for this year, let's call it maybe a 75. But going into next year and also possibly considering the possibility that Fed share, what happens there. So there could be additional ones maybe also next year. But yeah, and indeed, we also don't think they're in a hurry. So maybe September, let's call it that, is perhaps the time when they really start going more into it.
Where to when it comes to US assets like the dollar, right? Because it doesn't seem like a one-way bet at the moment. Do you still question the idea of fading US exceptionalism after the recent rebound?
Yeah, we'll have to see. I wouldn't maybe read also too much into it, besides the fact that, yes, we also do think that the dollar can, but for also fundamental or rate reasons, right, could soften a bit more over the next 12 months. In the US, yeah, I'd say quality bonds, certainly, if I think about investment grade, for example, yeah, that's certainly an area where, especially when the rates are, this high, or also the the environment is that way. So the interest rates are pretty interesting there. On the equity side, we'd say right now we see a bit more of a neutral picture, at least in the short term, not necessarily about 12 months, but over the next couple of months. So we have the US on neutral, but also in here, right, we do see also from the corporate results, we do see the outlook here on AI, right, and the spending they're happening and the idea generation. And 25 is only one area of that, right? 26, 27, we're going to see innovations also on the AI side that keeps the investments going. So also here in the tech space in the US, there's still good opportunities, interesting opportunities to be active.
I know you have some views on gold as well, and we have seen the price calm down somewhat. Has this rally played out now, or do you view this more as a buying opportunity for future uncertainty ahead?
Yeah, certainly gold is an area that we shouldn't completely lose out of our sight, and especially also with the US dollar. Some of the discussions happening that we are seeing now, certainly it is something that in a portfolio context should also be looked at, and our forecast here is 3,500, so we do also see a bit of upside. So yes, from risk point of view, it should certainly be also considered in a portfolio context.
All right, Hartmut Issel, head of APAC Equities and Credit at UBS Wealth Management. Thanks so much for joining us. We have more ahead on the Asia Trade. This is Bloomberg.
Take a look at what we're watching when it comes to trading here in Sydney. Westpac is in focus, along with a number of banks after that rate cut from the RBA yesterday. But Westpac in particular planning to cut over 1,500 jobs as part of a major overhaul to meet cost cut targets. This has been called Unite, involves simplifying processes, and tech managers have been asked to reduce staff by 5% across most teams over the next few months. Westpac has been pushing into some of these lower margin businesses for business lending, I should say. That's had an impact on earnings. Those shares are down about 5.8% since it released results earlier this month. A little bit of upside for Westpac today.
All right, let's take a look at how some of the key commodities that we track are pricing at the moment. We're seeing Brent crude giving up some of the gains that we saw earlier. It's still pretty strong, though. This is on a report that Israel may be preparing to strike nuclear facilities within Iran. That's propelling a lot of other commodities higher as well. We did see a little bit of softness in the copper price earlier. Copper production in China climbing to a monthly record in April, but prices at the moment just ticking a little higher. Iron ore prices just below $100 per tonne. Well, the LME Asia Week event begins in Hong Kong today, bringing together industry leaders and market participants from the metals and financial communities. And our next guest runs the LME, which hosts the global benchmark prices for key industrial metals such as aluminium, copper and nickel. Joining us now is CEO Matthew Chamberlain. And Matthew, besides the gathering this morning, I understand that you're opening some more warehouses in Hong Kong later on this afternoon. Can you give us a sense of how profitable warehouse space is in Hong Kong at the moment when you consider factors like transportation, labour costs, etc.?
Yeah, absolutely, and great to be here. So when we actually, at this event last year, announced our intention to set up warehouses in Hong Kong, we absolutely acknowledge that Hong Kong is a higher cost jurisdiction, given land costs, given logistical costs. But, you know, some of that volatility that you were talking about in the copper price, I think that really makes the point around the economics, because when there is market tightness, perhaps a backwardation or a squeeze, then the physical metals community needs to be able to get metal into warehouses, and they want those warehouses to be close to where they are, particularly close to the metal centers of mainland China. And in that case, they'll be willing to pay for that logistical convenience, that logistical flexibility, and we see that as very much underpinning the economic case for the warehouses here in Hong Kong.
Yeah, of course, a year ago when you made that announcement, nobody really foresaw some of the tariff and trade upheaval that we've got now. Can you give us a sense of how inventory flows have changed in the wake of what we've seen in the trade environment?
Yeah, it's a great question because I think you, as always, have this combination of fundamental and technical factors. So from a fundamental perspective, there's no doubt that there's been a bit of softness in the metals prices. You're taking copper as that great economic bellwether, you're down about 7% in April, given the global macro uncertainty that's been engendered by some of these tariff announcements. But then I think actually more pronounced has been some of these technical effects. So, copper again, we've seen this significant flow of metal out of Asia into the US, trying to get onshore ahead of any potential tariffs coming into play, which has resulted in this significant stock shift out of particularly our warehouses in Asia over into the US. So you've got this combination of fundamental and technical factors undoubtedly driving volatility. We've seen a 20% swing in copper prices through April, but ultimately, that's what the exchange is here to help people manage, and it does create trading opportunities.
When it comes to the warehousing issue, there's obviously some detriments when it comes to higher transport labour costs for Hong Kong. What are the biggest concerns that you're hearing on this, and how do you envisage Hong Kong will compare to other hubs like Singapore?
Yeah, so again, I think the use of the warehouses may be slightly different in Hong Kong. So I probably wouldn't be expecting to see the long-term storage of some of our lower value metals like aluminium. We see a lot of that in the lower cost hubs of say Malaysia or of Taiwan or of South Korea. I think what the use case that I'm hearing from our clients, particularly in mainland China for the Hong Kong warehousing, is that when there are these market swings, and as we know, the export-import arbitrage for the mainland China metals business can open and close quite quickly, so that when there are these swings, you have the metal right at the doorstep of mainland China. And so that, I think, really goes to offset those logistical costs because people will pay, we believe, for the convenience of being 36 hours trucking time from Shanghai. So as I say, I think it'll very much be that more logistical use case, which of course is what the Hong Kong logistics industry is so good at.
When it comes to the impact of tariffs, what do you see as a disruption on flows? Is there going to be meaningful flows out of the US?
Well, as I say, I think we're in this initial period where, because, using copper as the example, because those tariffs haven't actually come into effect, we're undoubtedly seeing some rerouting of flows as people try to get ahead of the tariffs. Now, I think once tariffs come in, and we've seen this already on aluminium, where, of course, there are the 25% Section 232 tariffs already in effect in the US, what you tend to see is that there isn't a huge degree of disruption, because the LME has always been this global price. We were set up in 1877 in a much higher tariff environment even than today, and that means that we benefit from this duty unpaid structure. So we very much try to be that global baseline price driven by fundamental supply and demand, not driven by the tariff policies of any one country or region. You then have regional premiums and the merchanting business of bringing the business into and out of particular countries. But actually, in terms of that global price that we pride ourselves on maintaining, we don't see that tariffs, once they are set, are fundamentally going to change the way that the market operates.
Matthew, you mentioned a moment ago an appetite to have inventory closer to where it's potentially going to be used. Considering that, what do you think is an appropriate inventory size for, say, copper in Hong Kong?
Yeah, so we're not really in the business of setting what that inventory should be. That's ultimately going to be driven by the market. But I think the fact that we now have 7 licensed facilities here in Hong Kong, with five different operators, which between them could easily, I believe, store 50, 100,000 tons if that were the market's request. I think that gives you a sense for what the market might be thinking, because people wouldn't be setting up warehouses if they, if they didn't feel that there was that demand from their end clients. We can look at the authorized square footage and we can kind of back calculate from there. So, we're certainly set up for now for inventories of that size. Not for me to say what inventories should be, but I feel very confident that Hong Kong as a LME metals hub would be able to accept inventories of that size.
What are some of the broader ambitions for the region then? What next after Hong Kong?
Yeah, so look, Asia is a hugely important part of our business. I mean, if I look at the statistics, 85% of our warehoused metal now sits in Asia. And then on the producer side, 100% of the tin on LME warrant is produced in Asia, 2/3 of the nickel, 50% of the copper. So I think we really, since the acquisition by Hong Kong Exchange back in 2012, it's been a big part of our business model to be as close to the Asian metals community and the Asian metals industry as possible. And a number of the initiatives that we are now looking at, be that our data on LME Passport, be that our work on sustainable metals with our partners at Metals Hub, I think all of those things are very relevant for the Asian region and for the fantastic technology leadership that many of the Asian metals companies are now exhibiting. So we're going to be working really closely with our friends and partners here. A lot of good conversations today because we are a global network, but the global metals industry does have a huge Asian component, and we need to make sure we're servicing them as well as possible.
Matthew, really great to have you with us. Matthew Chamberlain, who's the CEO at the London Metal Exchange. Take a look at what we're watching when it comes to Japan bonds. Of course, so much focus has really been on what we've been watching for treasuries, given those concerns over the longer end of the curve. We're watching that 20-year JGB auction demand alongside what we're seeing when it comes to the curve for Japanese sovereign bonds as well. Let's bring in our Bloomberg MLive strategist, Mike Cran, for more when it comes to JGBs as well as the BOJ. Are we going to kind of need to see some downgrading when it comes to the longer end for JGBs as well?
It certainly appears as though long-term investors in Japanese markets, they seem to be fearing an event, something like we saw last week where Moody's downgraded the US rating. They're trading with yield premiums so high as though they expect it's imminent for the rating agencies to do the same in Japan. And it may well be that they will trade bearishly until they actually see that. There could be a something of a buy the rumor, sell the fact kind of response if that comes through. And certainly investors are getting no help at all from the Japanese authorities. The Bank of Japan held meetings this week with traders in the market, and they certainly indicated that they're in no hurry to do anything other than continue reduce the buying, which they've been doing for some time. Since Governor Ueda came in, he's been pretty clear on wanting to buy less JGBs, eventually with the objective of the BOJ holding very few, maybe no more than other central banks. They still hold a much higher proportion of government debt than most G10 central banks. So there seems to be a commitment there for them to buy less, which the traders can see. At the same time, you have stagflation concerns appearing in Japan as well. Inflation is very sticky, and yet growth in the first quarter was in contraction. So a very poor signaling to anybody who wants to invest in long-term bonds in Japan. Clearly, there's not much. You're not getting a decent spread above inflation. In fact, if you go for shorter bonds, it's deeply negative. So the real yields are bad for investors. It's not being helped by policy, where the Bank of Japan has also recently turned very dovish. They're not suggesting they're going to try and dampen inflation with rate hikes as well. So it's almost like a perfect storm. You just look at the Japanese market. No wonder the local investors are almost on a buyer's strike. They don't want to touch the long end of the market, and we have Bloomberg stories which indicate as much as that. There are foreigners participating in some long-term bonds, but most of that is being swapped back into their home currency, so it doesn't really support the market at all. And on top of all of that, you've got negativity at the long end of the treasury market, which is feeding back into Japan as well. It's a really nasty scenario, and maybe they do need to have a ratings downgrade to calm everybody down.
Mark, as you described, certainly don't seem to be any buyers willing to step in and fill the sizable void left by the Bank of Japan. How can appetite be improved for JGBs?
Eventually, long-term yields will reach a point where it's such a no-brainer that investors will say, yep, that yield is so appealing that I have to have some. Maybe the 30-year yield has to touch 4% before it becomes unequivocally good for life insurance companies and other people to say, yeah, we can live with the risks when there is so much bad news priced in. There's a long way to go before we reach that. As you can see, the yields on the screen there, they're not at the 4% level yet. Maybe that's what we need to see, a big round number where people are shocked into wanting to buy Japanese bonds. In the same way, we saw some buying of long-term US bonds when they reached 5% this week, although the yields are back to that level again. It's global, really. You see, with the concerns about tariffs, the fact that inflation could remain higher across the world, people really don't want long-term bonds. But there will be a point where the yields are so attractive, they've priced in so much bad news, that finally people will return to the market.
Bloomberg M Live strategist Mark Cranfield there. More ahead on the Asia trade. This is Bloomberg. Well, CATL's founder and chair, Robin Zeng, is pushing back on US accusations that the company poses a national security threat. Zeng told Bloomberg that the company has never sold any of his products to the military or for warfare. He was speaking in Hong Kong after the stellar debut of CATL's secondary listing. The US Defense Department has added that the Chinese battery giant to a blacklist of companies with alleged links to the PLA. Well, Chinese companies are rushing to put factories in Europe to avoid rising tariffs from the bloc, yet CATL's own experience highlights some of the drawbacks of that approach. Bloomberg reporter Josh Xiao spoke with the battery maker's Europe president, and he joins us now. So what were sort of the lessons learned when it comes to CATL's first overseas factory? Like in Germany, we know that so much of the funding that they got from the secondary listing is going to be used on this European expansion.
Yes, so some of the lessons from the German factory that we can learn during my visit there was that first thing is when you expand overseas, there's a certain trade-off that you have to make. One thing is, you become closer to your customers in Europe. For example, CATL was supplying batteries to BMW and Volkswagen, so that proximity certainly helps with the case. But on the other hand, it also has to contend with other drawbacks, such as the higher energy costs in Germany. The CATL's European President Matthias and Graf actually told us that it was impossible. It was actually very inefficient to operate under those circumstances. And then another thing is also the labor relations that's a little bit more difficult to navigate as compared to in China. And lastly, there was also this language barrier, cultural barrier. We talked to some of the employees there, and they told us about this interesting incidents where the German workers actually went on strike once because there was no more toilet paper in the toilet, and they read it as like a sign to force them to work more. So all those little things were mundane, but still critical things to take into account of when you expand overseas.
What are some of the other forces Chinese companies are contending with at the moment, and could it lead to fewer companies going overseas?
Yes, so there are other, besides local conditions, there's also the broader geopolitics at play here. Even though the US and China have reached a temporary truce in terms of the trade war, the Trump administration has signaled previously that it wants to sort of unite or rally allies to contain China's expansion overseas, limiting their investments, so to speak. So that would certainly pose a risk to Chinese companies that are heading overseas. And at the same time, back in Beijing, I think for President Xi Jinping, he's been very keen on emphasizing tech self-reliance. He's been very keen to emphasize that our key technology cannot be leaked to other countries that could potentially threaten China's dominance in those technologies. So those are the two main factors that Chinese factories or Chinese companies have to consider when they expand overseas.
Bloomberg reporter Josh Xiao there. Take a look at how European stocks are coming online when it comes to the futures session there. We are seeing potentially some further gains now for a fifth straight day. Euro Stoxx 50 futures and as well as German DAX futures both look a little bit modestly high. We saw those 4 days of that rally really being helped along by renewable energy stocks. We had Trump lifting an order halting construction on the Equinor project. Much more ahead here on the Asia Trade. This is Bloomberg.
Asus co-CEO Samson Hu says the Taiwanese PC maker may have to raise prices by about 5 to 10% in the US due to tariffs and costs tied to supply chain diversification. Speaking at Computex 2025 in Taipei, Hu told us how Asus is managing trade risks.
Our supply chain strategy is built around flexibility and diversification. So we are working very closely with our manufacturing partner to ensure that we have production capabilities around the world, including the US. That's very important. And that's why we also very carefully and very closely monitor the latest situation about the tariff policy and assess the impact to our supply chain.
What's the level of tariffs that you anticipate as a business? What's the base case scenario that you see?
I think, the recent US-China trade deal announcement is a positive development. So I think we are somewhat confident about the future of the global trade deal stability. However, I think the tariff policies still continue to shift.
Early this year, we had an interview with Asus, and you were talking about sending products to the US to get ahead of the tariffs in the fourth quarter of last year. Where are those inventory levels now, and how much of a buffer do you have as well?
Okay, that's an interesting question. Actually, we prepare those inventory levels since last quarter four. And usually we build the inventory level between 3 to 6 months, depending on different product category.
So then how much of a safety net do you have right now? How many months?
Still 3 to 6 months at the current moment.
Without having any sort of price changes to your products?
In terms of price, right, you are asking?
Yeah.
To be honest, we expect some price increase maybe need to pass on to our consumers. Especially for those products reliant on effective components. And at the same time, that we have long been diversifying our manufacturing footprint to address the tariff concern. And naturally, this will also bring extra logistic costs. So that's why we have started the price adjustment with our channel partners based on the condition to maintain our margin balance and based on the market acceptance.
So what's the increase you're expecting then on the price, and which products as well do you think?
The price increase in really vary quite a little bit depending on different product category.
Could you give sort of a range then of the percentage that you're expecting to increase?
It highly depends on the extra logistics cost and the possible tariff rate are going to impose. So usually it's 5% to 10%.
5 to 10%
yes.
Price increase, okay.
Yes.
And is that just for consumers in the US, or do you need to also apply this globally to try and offset?
Only in the US.
Let's talk about the demand for AI servers or AI PCs as well, because these are two different business lines for you. What are you seeing right now in terms of customer or business appetite?
Well, you're asking about the demand of AI, such kind of, okay. We continue to see strong demand for AI. That's because, AI is no longer optional for business. since it really helps them to improve operation efficiency and to stay competitive.
Well, we do have some breaking news coming through from Ofcom in China. They're talking about just the discontent when it comes to US moves to what they say is to damage the rights and interests of Chinese firms. The US abusing export controls when it comes to these chip controls and the US chip ban, and that China will take measures to safeguard their rights and interests. This is Bloomberg.